Tesla stock has increased 14x over the last 5 years, going from 15 to 209. Tesla hit a 52-week high of 279 in mid-September 2023, but it's pulled back more than 25% since then. Tesla is leading the charge in AI by developing autonomous vehicles and humanoid robots. So is now the time to buy this EV superstar? Let's dive in and find out. Quick shout out to Yannick E for suggesting this week's company. Okay, 4 points that we are going to cover in this video. Point number 1, background, business model, and company updates. In 2023, Tesla delivered over 1.3 million vehicles globally, maintaining a significant lead over competition in the EV market. They also offer solar energy generation and storage. The company recently reported 2Q24 results, and I've pulled out the key insights for you. Part 2, the future. Push into AI and their strategy. Self-driving vehicles, humanoid robots, the Dojo supercomputer are projects Tesla is firmly committed to. In fact, Tesla had an AI day to showcase advancements in AI, and this goes way beyond the core electric vehicle business. Part 3, the opportunity, positives, and negatives. Tesla is playing a big part in the AI revolution through autonomous vehicles and humanoid robots. But is this money well spent or a distraction from the core electric vehicle business? The stock is down more than 25% since hitting its 52-week high, so is now the time to buy? And part 4, valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow or DCF valuation. I've built a 3-statement model with a DCF for Tesla, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part 1, background, business model, company updates. So first off, background. The company was founded in 2003 by Martin Eberhard and Mark Tappening, with Elon Musk joining shortly thereafter as key investor and chairman. The company's headquarters in Austin, Texas, with a major manufacturing plant in Fremont, California. Leadership, obviously, Elon Musk serves as CEO and product architect, overseeing the company's strategic direction and product development. So key products and services: electric vehicles, Model S, 3, X, Y, Cybertruck, and Tesla Semi, and also energy generation storage, so solar products like the solar roof, solar panels, and energy storage solutions such as Powerwall, PowerPack, and Megapack. The company's mission is to accelerate the world's transition to sustainable energy. Business model: how do they make money? So 83% of revenues are from automotive sales. The majority of Tesla revenue comes from the sale of electric vehicles. Now, 2% of that is leasing. We're going to talk about this later because it's a really interesting thing that they're doing. They also have a direct-to-consumer sales model, bypassing traditional dealerships, and they're expanding production capabilities with gigafactories in the US, China, and Europe. 9% of revenues, software and services. So Autopilot, full self-driving software, sales and subscriptions, Tesla Insurance, offering competitive rates based on driving data, Supercharger network revenue, which charges a fee for non-Tesla owners. Next, 6% of revenues, energy generation and storage, solar products and energy storage solutions for residential, commercial, and utility customers. So growth in energy storage revenue has come through Powerwall, PowerPack, and Megapack products. And last but not least, 2% of revenues, regulatory credits. Tesla sells regulatory credits to other automakers who need them to comply with government regulations on emissions. So what's the takeaway? While Tesla's business is primarily around electric vehicle sales, we will continue to see the other pieces grow in significance, and that's where I see the greatest opportunity. All right, company updates, 2Q24 results. So revenue performance, total revenue, Tesla reported $25.5 billion for Q2 2024. That slightly beat the market consensus estimate of $24.77 billion. It represents a 2% year-over-year increase from Q2 23. Automotive revenue, which includes vehicle sales and leasing, generated $19.9 billion. Now, that was down 7% year over year. Auto revenue included record regulatory credits of $890 million, more than triple the figure from last year. Energy generation and storage revenue grew $3 billion, an impressive 100% year-over-year increase. Megapack and Powerwall achieved record deployment in the period. Services and other revenue, which includes after-sale services, Supercharger network fees, and other sources, generated $2.6 billion, which was up 21% year-over-year. All right, profitability and margin. So net income was $1.8 billion, down 42% year over year due to a drop in automotive revenue. The EPS, or earnings per share, was 52 cents, below the consensus estimate of 62 cents. Now, don't be too alarmed. A lot of this was due to growth initiatives that we're going to be talking about in a bit. Operating income for Q2 was $1.6 billion, reflecting a 33% year-over-year decrease. Operating margin came in at 6.3%, down from 9.6% a year ago, due to higher operating expenses related to Gigafactory expansion and R&D investments. Key developments and strategic updates. Gigafactory progress. Tesla continues to ramp up its gigafactories in Berlin, Germany, and Texas, with plans to further increase capacity in both locations. The Berlin Gigafactory is expected to reach full capacity by the end of 2024. AI and FSD developments. Tesla highlighted advancements in its full self-driving FSD software with plans for wider beta releases. The company continues to invest heavily in AI development, particularly in enhancing its Dojo supercomputer capabilities. So we're going to cover AI investment in detail in the next part of the video. I think this is the big part of the investment thesis. Energy business expansion. So Tesla's energy division showed strong growth with significant investments in expanding megapack production and continued growth in solar installations. The company expects the energy segment to become a more substantial contributor to overall revenue in the coming years. Pay very close attention here. Elon Musk spoke to the potential for monitored self-driving being the long-term goal, mentioning that Cathie Wood from ARK Invest has a value of $5 trillion, which is 7x today for Tesla when it's fully deployed. Now, adding the Optimus robots results in a valuation several times higher than that. Musk anticipates having several thousand Optimus robots produced and working in Tesla factories by the end of next year, 2025. Now, none of this is in the model nor the current numbers. So this is the true potential of the company, but it's not captured. So what's the takeaway? Tesla's Q2 2024 results exceeded market expectations on revenue, but not earnings. The company's ongoing investments in AI gigafactory expansions and energy products position it well for future growth. It will need to navigate ongoing supply chain challenges and competitive pressures in the evolving EV and renewable energy markets. All right, part two, the future. Push into AI and their strategy. So focus on artificial intelligence development. AI as a core competency. Tesla views AI not just as a component of its products, but as a central pillar of its strategy. Tesla had an AI day where it showcased its advancements in AI, including updates on self-driving technology, their Dojo supercomputer, and humanoid robots. We're going to cover each of these right now. So self-driving vehicles, autopilot, and FSD are full self-driving. Tesla's FSD software aims to achieve level 5 autonomy, which would enable vehicles to drive themselves without human intervention. Data collection and neural networks. Tesla leverages vast amounts of data collected from its fleet of vehicles to train its neural networks. This data-centric approach allows Tesla to improve its self-driving algorithms continually. Dojo supercomputer. So Tesla is building the Dojo supercomputer, designed to specifically train its AI models more efficiently. It's expected to significantly speed up the learning process for Tesla's AI, making advancements in self-driving capabilities faster and more reliable. Humanoid robots. So Tesla announced the development of a humanoid robot named Optimus, which intends to perform repetitive or dangerous tasks. The applications range from factory and logistics tasks to more general labor in different industries. The long-term vision includes having the robot assist in households, potentially revolutionizing daily living and work environments. Think of the Jetsons.
Yesterday, I walked out of here with my shoes on my ears.
Integration with Tesla's ecosystem. The robots are expected to use the same neural networks and AI algorithms developed for Tesla's vehicles, creating synergy in software development and deployment. AI strategy, future outlook. So monetization. Tesla plans to monetize its AI technology through software subscriptions, FSD, robot sales, and future services, creating new revenue streams beyond traditional car sales. Uber disruptor. So once full self-driving is achieved, an autonomous ride-hailing network would provide an Uber-like service without human drivers, dramatically lowering operational costs. Expansion of AI applications could be applied to other areas, such as manufacturing, automation, logistics, and smart home technologies. The long-term vision. So Elon Musk has hinted at a future where Tesla could be seen as more of a robotics and AI company than a car manufacturer, highlighting the transformative potential of AI in driving Tesla's future growth. And remember, none of this is captured in current or projected financials in our analysis. So what's the takeaway? Tesla plans on leading the way in AI innovation, and in a future where autonomous vehicles and humanoid robots become commonplace, Tesla will prosper tremendously. All right, part three, opportunity, positives and negatives. I like bad news first, so let's hit the negatives. Geopolitical risk. Tesla's significant exposure to China, key market and production hub, poses risks related to geopolitical tensions and regulatory changes. Production supply and supply chain challenges. Ongoing supply chain issues and production delays could impact delivery targets and financial performance. Regulatory risks. Potential for regulatory changes related to EV incentives, the $7,500 tax credit that we have in the United States, emission standards, and autonomous driving regulations. Elon Musk's influence. So Musk's public statements and actions can lead to market volatility and impact investor sentiment. Now, I want to mention Elon Musk's compensation case was in the news for a while, and rather than rehash it, you could check out the detailed video where I covered it top to bottom right here. Competition. Increasing competition in the EV market from traditional automakers like Ford, GM, and Volkswagen, and new entrants such as Rivian and Lucid could pressure market share. Valuation concerns. Tesla stock is often criticized for its high valuation compared to traditional automakers, posing a risk if growth expectations are not met. Now, personally, I think this is where the advantage lies for Tesla, as we discussed earlier with AI. All right, positives. Strong brand and market leadership. Tesla is a leader in the EV market with strong brand recognition and customer loyalty. Sustainability focus. Tesla's commitment to sustainable energy aligns with global trends and government incentives promoting green technology. Innovation in technology. Continued innovation in battery technology, software for FSD, and energy solutions positions Tesla as a tech leader. Positive market sentiment. The stock has shown resilience and potential for further growth, especially with advancements in FSD and AI technology. Expanding production capacity. So new gigafactories in Berlin, Germany, and Texas are set to increase production capacity and reduce costs. Revenue diversification. So growth in the energy business and software subscriptions provides a diversified revenue stream. So what's the takeaway? While there have been bumps in the road along the way, Tesla's future looks bright, and it's being proactive with AI and its potential. All right, part 4, the moment we've all been waiting for, the valuation. So we're going to start out with the balance sheet. There's been a massive 7x increase in cash over the last 5 years, going from $4.3 billion in 2018 to $29.9 billion in 2023. There was a 55% increase in other assets, and $6.7 billion of that is from deferred tax assets, which are tax benefits the company can realize in the future. The company is net cash, meaning cash is greater than debt by almost $25 billion, with cash of $29.9 billion and debt of $5.2 billion. This provides them with tremendous option value for that cash. We're going to see this next in the income statement. Also, it's important to note that the company has a $5 billion revolving credit facility available until 2028. They've not drawn on it. Think of like a credit card, but for a company. Retained earnings turned from negative to positive in 2021, and it has increased 2.2x last year. So what's the takeaway? Tesla is a cash machine that is very underlevered with debt to total capital of only 1%. Let's hop in the model. All right, so as we mentioned, 7x 5-year increase in cash and cash equivalents, which is remarkable. You could see that up here, almost $30 billion. Other assets, big increase here, but remember, I mentioned the deferred tax asset. Debt has decreased significantly. I do want a future pace for you guys. There is something very unique about their debt, which is actually pretty exciting, and I'm going to discuss that a little bit later. Retained earnings, we see a nice big jump here, up to $28 billion. All right, next we have the income statement. Revenue has increased 3.1x, while net income has increased 17.4x over the last 3 years. This shows tremendous operating leverage, which means operating costs have decreased on a relative basis. Remember, revenue is what you make, net income is what you keep. EBITDA margin has gone from 8% to 14% from 2018 to 2023, which is a 182% relative increase. Net margin has gone from negative 5% to positive 16% from 2028 to 2023. Because Tesla is net cash, as mentioned earlier, they are also net interest income, which means money they make on cash invested is greater than interest they pay on debt. They had a massive tax benefit of $5 billion that they received in 2023, which boosted their net income. Net income went from negative to positive in 2020 and is the primary driver of free cash flow. We're going to see this next in the cash flow statement. So what's the takeaway? Despite being primarily in the automotive business, Tesla is growing at double digits top line, and the operations are being run very efficiently with costs being kept under control. With a 3-year average return on equity of 27% and return on invested capital of 23%, there's lots of positives for investors. Let's hop in the model. Income statement. So revenues 3.1x over the last 3 years. Pretty remarkable. You could see almost eclipsing $100 billion. That's going to happen within the next year. Interest income is greater than interest expense. Remember, we mentioned that they're net interest income. This is huge. That means they're positive to the tune of $900 million. Also, tax benefit of $5 billion. This is a huge, huge development right here. And then we see the 3-year increase in net income, 17.4x, versus the 3-year increase in revenues of 3.1x. They're heading in the right direction. Next, we have the cash flow statement. So operating cash flow is increasing, but down in 2023. This is mainly due to the increase in deferred tax assets that we talked about earlier. And this is because an increase in an asset is a cash outflow. Strong growth in free cash flow, first turning positive in 2019 and then increasing 4x from 2019 to 2023. This is tremendous. Tesla has not issued equity since 2020. This is a major development for shareholders since they're not facing dilution, and it indicates this company is self-sustaining and self-funded. While Tesla issued debt in 2023, it's a special kind of debt. We're going to discuss this next in the forecast drivers and DCF assumptions. So what's the takeaway? Cash flow trends are headed in the right direction, and in our model, cash will more than 4x by 2028 if the trend continues. Let's hop in the model. All right, cash flow statement. What we can see here, free cash flow increased tremendously. We also see right here, their operating cash flow, massive growth, massive increase. I mentioned the decrease in the operating cash flow in 2023. That's due right here to the increase in deferred tax assets. We also see that they issued $3.9 billion of debt in 2023. I'm going to cover why that debt is pretty special momentarily. Also, the last thing that we see here, a 4.4x increase in cash by the end of our model if the trends continue. All right, next we have forecast drivers and DCF assumptions. So revenue growth is increasing at a decreasing rate. Being conservative, we went with 14%, which you're going to see is below Wall Street consensus estimates of 14.6%. Tesla has been controlling operating costs, specifically SG&A and R&D, which were 20% in 2018, down to 9% in 2023. But to be conservative, I bumped it up to 10%, especially considering the increase in R&D related to the push/commitment to AI. $42 billion of debt has been paid over the last 5 years, with another $4.5 coming over the next 5 years. This is very manageable considering nearly $31 billion of cash is what they have as of 2Q24. They have a high beta, so something to think about, 1.5. That results in a high WACC. This is mainly due to the rapid 14x increase in the stock over the last 5 years. Now, they do have low leverage, only 1%, and a BBB credit rating, which is investment grade. Now, 55% of their debt is ABS, or asset-backed securities, against car leases. I'm going to explain this when we get into the model. It's pretty cool stuff. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, so right here, very important to understand, we're actually below consensus over the long term. We chose a 14% top-line revenue growth, whereas Wall Street consensus is at 14.6 for the 5-year compound annual growth rate. Another thing to note over here, debt pay down, they have $4.5 billion of debt to pay down over the next 5 years, which they can easily handle. All right, DCF assumptions. So risk-free rate, beta, which is pretty high, market risk premium, we get cost of equity of 9.7%. They do have a BBB credit rating, which gives them a higher pre-tax cost of debt. They end up having super low leverage. So relatively speaking, their WACC is high, but it's not crazy. Also, I want to mention right here, $4.2 billion of their $7.7 billion of current debt is ABS, or asset-backed securities, against car leases. So they did something really cool here. The car leases that they have and the cash flows that they're receiving from that, what they decided to do was issue debt and have the car lease revenue support that debt. This is something that we actually see common in the automotive space, where companies will offload their incoming revenues from leases so that they don't have that liability. They get the cash up front and then they support that debt with those future cash flows. Something very interesting, they have 184 million of crypto. They have cash and cash equivalents of 30.7 billion as of 2Q. And then their current TEV to EBITDA is 50.8x. Now, this is going to give us the terminal multiple, which is the bulk of the valuation. So the average over the last 8 quarters was 41.3. I went with 40. Remember, there's so much stuff going on here with AI, robots, full self-driving that's not captured in the current numbers. So I feel very comfortable going with this multiple. All right, DCF valuation, we ran 3 scenarios, bear, base, bull, with the current model at base. Future cash flows are discounted back to today to get to TEV, or total enterprise value. We strip out net debt to get to equity value. This company is high growth. They have lots of cash and a big push into AI with FSD, Optimus, and Dojo. But is it worth buying today? Now, Wall Street has Tesla at a median of $211. That's a 1% discount. But what does our analysis show? Let's hop in the model. All right, y'all, DCF time. EBITDA less DNA gives us EBIT. We strip out the cash taxes. We get EBIT or NOPAT. We add back the DNA. We have changes in operating working capital, CapEx. We get FCFF, our free cash flow to the firm. Remember our terminal value, 40 times terminal EBITDA. We get our cash flows to discount. The discount factor is what's the time value of money value of these future cash flows. We get the current value of these cash flows. That combines to get us TEV, or total enterprise value. We strip out the debt, we add the cash, we strip out the non-controlling interest, we add in the associated investments, we get an intrinsic equity value of a little more than $900 billion. We divide that by the shares outstanding, we get an implied share price of $284.12 compared to the current close of $209.21. That is a 26% discount, which is a screaming buy. Okay, next we have sensitivity and scenario analysis. We ran 50 different models utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as WACC versus the terminal multiple. Now, here were our findings. 0 showed a sell rating, 9 out of 50 or 18% showed a hold rating, 41 out of 50 or 82% showed a buy rating. We ran each of the 3 scenarios equally weighted, got a weighted average value of 292, which is a 28% discount. So what's the takeaway? Even utilizing conservative assumptions, we show a buy rating for the stock. Let's hop in the model. All right, everybody. As you can see here, tons of green everywhere, even in our conservative scenarios where we have lower CapEx intensity or a lower terminal multiple and a higher WACC. What we basically see is, even with very conservative assumptions, we have majority buy across the board. Coming down to our scenario analysis, remember, we equally weight each of these scenarios. So we get 202, 284, and 391. We multiply each of those by 33.33%. We get a sell in the bear case, 202. But we get a buy and a screaming buy in the bull case. So we get a weighted average value of $292. It's a 28% discount, which is a buy rating for the stock. All right, wrap up. Wall Street has Tesla at a median of $211, which is a 1% discount, with a high of 310, which is a 48% discount, and a low of 85, which is a 59% premium. So it's a really wide gap there. Our analysis showed Tesla at a value of around 284 to 292, which is 26 to 28% upside. Now, you should seek the advice of an investment professional always. I don't know your personal financial situation, and this content is meant to educate. It's not investment advice. That being said, I do own a position in Tesla, and I think that this is one of the best plays in the Mag 7 if you want exposure to AI upside. Full self-driving cars to take on Uber and Lyft, humanoid robots that will do your laundry, wash the dishes, and other monotonous household tasks, and none of this is captured in the projections on the revenue side, only the cost side via research and development. While Tesla is currently an electric vehicle automotive business, it's morphing into more of an AI robot technology business. Despite that, it is still an amazing EV opportunity with the other opportunities as icing on the cake. The valuation is compelling, and betting on the Leonardo da Vinci of our time, Elon Musk, running a company that is flush with cash, betting big on AI, is something I feel very comfortable doing. With almost $31 billion in cash and growing, very little debt, and a return on equity of 28%, I feel that Tesla will be the front runner in self-driving cars and AI humanoid robots. Now, if you like this and want to see another tech valuation, you can check out my Microsoft model here or my Intel model, which you can find here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.